Three AI stocks you don't want to miss during this August downturn. All right, so if you've been following this channel, like I mentioned, you do know that I'm very bullish for the AI space. And the AI space is something that hits everything from data centers, from software, for semiconductors, from hardware, and the list goes on and on. And this chart right here kind of explains my bullish thesis. Right now, we can see that firms believe that by calendar year of 2028, capital expenditure is going to be over $1 trillion by the big four and by companies like Tesla, Stargate, and OpenAI. And this is easily becoming a reality as we have already gotten some amazing earnings in the past few weeks, where we're seeing all these big tech players increasing capital expenditure dramatically. So that overall trickles down to a lot of these AI companies. So the three AI companies I want to take a closer look at are going to focus on one, the data center, two, AI chips, and the other one's going to focus in the AI software space. So the first company, which is going to be the one focusing on data center, is going to be Marvell, ticker MRVL. Now, this is a company that designs and sells semiconductor. The main reason I have this in the data center space is because this is the company that helps data centers or these big cloud service providers design their own ASICs and DPUs and kind of their own AI chips. They also have a lot of networking solutions that help a lot for storage solutions, networking, and kind of communication solutions as well, which are all crucial for the data center space. Now, the way they make money is pretty much through those hardware sales, right? Selling those chips, selling that engineering for those custom AI chips. And we can see for fiscal year of 2025, their data center market was about 75% of total revenue. They are also in other markets, but the big portion is that data center space. And this is ticker MRVL if I didn't mention it. Now, one of the greatest things is this company just recently had an AI event and they increased their data center total addressable market dramatically. Last year, they had it at about 75 billion, but the way the growth in data center space is happening, they expect this to be at $94 billion by calendar year of 2028. Now, for those that are not familiar, Marvell has a market cap of about $60 billion right now. So just looking at those calendar years, they're pretty, they have a lot of growth opportunities right now. Now, they also do have a lot of ASIC chips. And like I mentioned, we heard that the data center market is about 75% of this company's total revenue. So this is the market that I'm mainly focusing on. And they are already working with top four US hyperscalers with emerging hyperscalers as well. Those could be like your XAI or OpenAI on developing some form of AI chips. And right now they have about 18 accelerated custom compute sockets, which can all be multi-billion, not all of them, but in theory can be a multi-billion-dollar opportunity for a lot of those placed there. Now, if we kind of look at this company, data center, like I mentioned, is becoming a massive portion of this company's total revenue. It's kind of really pushing this stock to continue to see new highs in total revenue compared to the past few years, right? We're seeing that nice growth mainly driven by the data center market. Now, the other thing about this, and this, all these great charts, you're going to find at fiscal.ai. And if you are serious about investing in general and collecting data at a very quick pace using a lot of AI solutions as well, check out fiscal.ai/Jose for 15% off any of their plans. I use it on a daily basis. And even if I wasn't a partner with them, I would be using this every single day. So if we look at forward PE ratios for Marvell, right now sitting at 25.1, the median in the past 3 years has been about 29.61. So I do believe this is trading very cheap, and I do believe there's massive amount of growth opportunities out there. The other thing is this company does do a nice amount of buybacks. We can see the kind of in the last 12 months, the amount of buybacks they have done, and they do pay a dividend as well. Now, maybe one of the biggest red flags for this stock, though, is there's always some bearish sentiments, right? I want to say their balance sheet is not the best, while they are positive in free cash flow. Over $1 billion in free cash flow, and they have almost $1 billion in cash and long-term cash and cash equivalents. They do have a nice amount of short-term debt, almost 1 billion that they need to pay off by the end of within the next 12 months. And they also have a nice amount of long-term debt as well. It's not a company that I believe is going to go under. I'm pretty sure it's going to be able to refinance this, especially with that strong cash flow and that strong cash balance. But it's still something to keep an eye out, that they are that they do have a nice amount of debt behind them. Now, I want to kind of talk a little bit about the low-hanging fruit from Marvell. And I think the easiest way for this company to kind of expand those multiples and seem extremely cheap is the recovery in non-data center markets. For example, we're looking right here. We saw that the data center market in general, and let's kind of look at these charts again from fiscal.ai pretty quickly. Data center market has been growing dramatically for the past few years. The other markets, though, have not. We can see this is their enterprise, their carrier, their consumer, their automotive. This kind of is only finally starting to pick back up. But we can see in January of 2023, it peaked at around $3.5 billion. Now, unfortunately, inventory correction has hit this pretty hard. But imagine when you have that growth from the data center market, and then you have the growth of all these other segments picking back up, you see a nice revenue and a nice growth in earnings per share and free cash flow. So I think that's the easiest low-hanging fruit here for Marvell. Now, I kind of want to talk about the moonshot upside versus the bearish thesis. I think the moonshot is all these custom AI silicon market dominance, right? They like we saw, they increased their total addressable market here dramatically in just 1 year. We are seeing right now big data center companies increase their capital expenditure. So there is that bullish sentiment there. The other thing is they do have great partnerships with Microsoft and Amazon on form of developing some of their custom chips as well. Now, the big bearish thesis here is one, intense competition. You have companies like Broadcom that are the market leader in custom ASIC. You also have a lot of other players in Asia as well. So the competition is pretty high for a market that has very limited amount of customers. The second thing is customer concentration. If any of their major customers in the ASIC market say they want to go somewhere else, it could create a major pressure on revenue or major headwind on revenue. So I'm actually very bullish on Marvell. I do own this, and I do believe with a market cap of about $60 billion, the opportunity is just too massive for me to overlook this stock. Now, in the short term, I do believe this is a stock that's going to be very volatile due to any noise in the AI market. In the long term, I do believe that this is a multi-bagger potential. Nothing is ever guaranteed in the market, but I do believe it has the potential as it does have the right pieces to fit that growth opportunity. Now, if you are enjoying the episode so far, make sure to hit the thumbs up and subscribe button. I'm trying to hit 75,000 subs by the end of this year, and I would truly appreciate it. Also, check out my free newsletter at whatthechiphappened.com. And like I mentioned, if you want to get all these cool charts, check out fiscal.ai/Jose for 15% off. You're not going to regret this. Now, stock number 2 is going to be in the AI chip, and this is actually going to be ASML Holdings, ticker ASML. For those that are not familiar, this is a company that produces semiconductor equipment needed for chip manufacturing, i.e., it is crucial for AI chips. Those machines are known as DUVs and EUVs lithography machines. Now, how they make money? Pretty upfront. They sell equipment. They get money out of that. The second thing is once these equipments are hundreds and hundreds of millions of dollars per equipment. Outside of the equipment sale, they have kind of a recurring revenue through maintenance plans, to fixing the machines and kind of upgrading the machines over time, making updates to the software, to the hardwares, selling the parts that you need to kind of keep that maintenance. So they have that reoccurring revenue. Now, if we look at ASML, one of the biggest things is there's only a selected amount of customers for this company to have, right? Only a few companies are manufacturing chips: TSM, Intel, Samsung, Micron, SK Hynix, and again, a few handfuls, and that's it. And the major players is you can probably fit in one hand. So it is very customer concentrated. Now, there is kind of a few things here that investors should keep an eye out. First, net system revenue, which is the light blue, has been kind of growing, right? We see kind of in the last 12 months about $24 billion in net system sales. So this is how much they sell from their overall equipment. Now, unfortunately, net bookings, which is how much future orders they're taking in, is right now lower than net system sales. So in theory, if this continues indefinitely, eventually this company will not have enough backlog, and that would create some pressure on revenue growth, right? Imagine if you kind of keep going in this pace for the next few years, your backlog will go to zero and you will only be able to make revenue of the type of bookings that you are making. Now, I do believe we are in a very weak space in the equipment selling space, and there are going to be years like we saw here in 2021 and 2022 when net bookings was growing dramatically, and that's what creates this massive backlog. And then there's going to be years where revenue is outpacing that, and I believe these cycles are going to continue. So it's not something that I would necessarily be worried about ASML, but it is something that investors are concerned about at the moment and is creating that negative pressure. Now, the other great thing is services. Like I mentioned, that maintenance revenue is about 25% of total revenue and consistently is in those 20s, high 20 rates. I believe that's pretty strong as, again, it's not solely dependent anymore on equipment being sold, but this maintenance is a great margin business and it's a way for them to offset a lot of the weakness in the industry. The company does have a nice amount of total cash, long-term and free cash flow. I mean, free cash flow of about $10 billion in the past 12 months and long-term debt of about 3.7. So this company is able to be very healthy even during a downturn scenario. Now, in terms of forward PE ratio, right now sitting at 25.82. The median is 29.36. Again, I believe this is another player that is sitting pretty cheap compared to its overall median. And I do believe this gives us opportunities to get into certain stocks that normally trade at higher valuations. Now, the craziest thing that I want to kind of showcase is this company in the past few quarters has increased their buybacks dramatically. If we look at December of 2024, this company barely bought $500 million of stocks. We can kind of look in the last 12 months, and most of this is coming from the first and second quarter of this year. They spent about $4 billion in buybacks, and I actually believe these are all in euros, so it's not too much of a difference there, but 4 billion euros there. And again, most of those buybacks are happening in the past 6 months. I'm gonna say that this is gonna be one of their biggest buyback years as the stock has gone down dramatically. And the ASML believes their stock is cheap. I actually see that as a very bullish sentiment. Now, the low-hanging fruit, to me, the low-hanging fruit is two things. First, the service and upgrading. As they continue to sell more equipment, that services and upgrade business is going to continue to grow and grow. Their older fleets are going to need even more maintenance and more upgrades where they will be able to make more money as well and have more of a margin improvement there. The other thing is we are seeing a rebound in the memory space, and things like HBM is creating a need for some of ASML's machine, as there are some form of memory makers that are thinking of moving into EUV lithography when it comes to some of the memory manufacturing. So that's pretty impressive, as those two are ones that are happening right now. Now, the moonshot upside for ASML. As AI continues to grow, as electrification, as robotics, Internet of Things, the amount of chips that are going to be needed in the future is going to grow dramatically. You're going to need more lithography machines. The other thing is the improvements of margins from their equipment as they get better and better. So those are the moonshot upsides. Now, the bearish thesis. The semi-capital expenditure for equipment is very cyclical. Manufacturing companies is, like I mentioned, only a handful of big players, and sometimes they slow down investments right now, like we see with Intel. And that kind of brings down to the other one. The customer concentration is a bearish sentiment, and geopolitical and export restrictions is creating some form of tensions in the semiconductor equipment space. Now, some recent updates that maybe ASML investors should know. Intel is slowing down capital expenditure. That could be seen bearish for ASML. On the other end, though, you have big players like TSMC and memory players increasing their capital expenditure. So that could be a bullish sentiment. We also had some more updates with the EU and US trade deals, and this reduces a lot of the uncertainties, and hopefully management can give us better updates and better clarity on the business in the next quarter, which will be about 3 months from now. Now, my final thoughts here. In the short term, I think the market will continue to put pressure on the short term headwinds of the cyclicality in the semiconductor equipment space. In the long term, I do believe this is a market beater as AI drives demand for more chips, smaller chips, and you will start to see an increase in ASML equipment needs, especially when AI hits the consumer market at scale. Imagine the robotics, the autonomous cars, the IoT, the AI glasses, and so on and so much. If the consumer adopts anything like this, like wildfires, then you're going to need a lot more supply chain products and you're going to need more ASML equipment. Now, the third stock we're going to take a closer look at is one of the stocks that I really do enjoy right now. This is going to be the software play. This is going to be GitLab, ticker GTLB. So this is end-to-end DevSecOps. They do a lot. They kind of have this full suite of everything you need in the development of software. Most people believe when you're developing software, all you need is code, but it's not, right? I mean, you're creating this, you're working with a massive amount of teams to be able to do this. After you run or set up whatever you're working with, you need to continuously check everything's good. You need to update it. You need to repush it. The process of code developing is one that's always alive, right? It continues to be alive. And you need something that has a full suite solution that is able to be there throughout every single step. And that's what GitLab has, right? It's a single application where many other companies are, where they're, the thing about GitLab is many people think they have a lot of competitors. They have competitors in certain process, but there's not real one player that does it all like GitLab. So how they make money? Very simple. They have a seat and usage based subscription. They have various fees, and then you can also get add-ons like maybe some form of extra AI solutions that you want to add on at a price. If we kind of take a closer look, this company has plenty of cash, about 1 billion, no long-term debt, and it is kind of breaking even in free cash flow. Things are improving, but that positive and super amazing cash and short-term investments is what gets me excited, especially with no long-term debt. Now, in forms of price to sales ratio, this company is sitting way below 8 right now, and it is closer to its min than the median. I think it's pretty wild how low this stock is sitting right now. And I'll explain the reason why. I do believe it's a lot of market sentiment, very similar to what we're seeing with Adobe. And I believe the market is getting this one wrong. The low hanging fruit, I think easily they can expand seed expansion inside existing logos, which is very easy to do and can be one where they don't need to continue to upsell to a new customer. Older customer can just buy more seats for them, and that tends to be at a higher margins. They also are adding a lot of AI solutions like GitLab Duo Plus and some form of AI agents that they just announced recently that could create an easier way for monetization. They also recently got an authorization to sell the markets to federal and state contracts, which open up another opportunity. And their free service is limited to certain solutions, so it does push them to enter into the paying platform. So I do believe there's a lot of low-hanging fruit that can help this company grow. Now, the moonshot upside versus the bearish thesis. First, the bearish thesis. I think this company seems to have a lot of competitions, and whenever you hear something about maybe GitHub, Copilot from Microsoft, it creates this negative sentiment. I do believe that's what's happening recently after Microsoft reported earnings. The other kind of bearish thesis here is share-based compensation is still pretty high compared to total revenue. And to me, the moonshot is this is a company that can grow dramatically. It is a multi-bagger as enterprises can consolidate fractured tool chains. And actually, a lot of these other tools that are used are not necessarily competitive, but more kind of accredited, where you can use a lot of these platforms plus GitLab as well. So overall, I think there's a lot of moonshot, especially for a company that's sitting at less than $10 billion market cap. Now, my final thoughts here on GitLab, the short term, I do believe the market will fear any AI coding company as a massive competition. I think that's the fear with GitLab, where like, oh, look, AI will make your moat weaker. I don't think that's necessarily the case. Long term, long term, I think this company with a market cap of less than $10 billion, this is another multi-bagger potential. Not a guaranteed, but it does have the potential to be a multi-bagger. Now, just a quick look at market caps. ASML right now sitting at 267, Marvell sitting at 64, GitLab sitting at about 7 right now. In forms of year-to-date performance, ASML is down roughly 2.7, GitLab is down about 25.8, and Marvell down 34.4 year-to-date. Again, all of these are looking pretty exciting for me. I am more of a growth investor. So the ones that are in my portfolio and I'm super excited about right now is Marvell and GitLab. But ASML being the management adding so many in buybacks like we saw in the charts is insane to think that this is a company that many believe is kind of game over for their monopoly, which I don't think is the right story. I think this is one where in the short term it looks bad, but in the long term it's going to look like that was an easy one to pick. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you all next time.